Hey, in today's things that are important but incredibly underappreciated, first going to note that I look like garbage run over twice, which is an artifact of having small children that all decided to wake up at different points during the evening last night. So I might not necessarily be on my game as much as I'd like to be. But what I'm going to talk about is a topic I've talked about before, which is the competitive alternative that money market accounts are relative to a savings or checking account. So yesterday, the Fed announced that they were not going to raise the federal funds rate, but they're going to stay higher for longer. And we've seen just a massive disruption in the bond market, in the equity market, in response to this idea of higher for longer. In addition, it looks like the Federal Reserve, at least probabilistically speaking, is probably going to raise another quarter point this year. And so if we think about what this aggressive tightening by the Fed has done, is it's created this great outside opportunity for savers to put their money in a money market fund or a money market account and earn a much higher level of interest than they could in traditional savings or checking account. So just as one anecdote, you can invest in Vanguard's money market fund. Ticker is VMFXX. And right now, you're going to earn about 5.26%, at least based at the current rates. And those rates really follow the Fed funds rate. So given that the Fed is going to be staying higher for longer, you can sort of expect to earn that high level of yield on almost a risk-free investment for some time. If you compare that to what bank deposit rates are, say on a savings account, you're earning basically nothing. So if you were to invest, say, $100 into your bank, you'd get basically nothing after a year. Whereas in a comparable account in a money market fund with, like, say, Vanguard, you'd earn $5. So as you can see, there's a huge incentive to leave your savings and checking accounts if you have just idle cash that you're not doing anything with, and put it in one of these yielding safe investments like a money market account. That said, that's bad for banks. As banks um, lose deposits, that can be problematic because banks are not a piggy bank. They lend money out and they don't always have the money on hand. And so we're going to continue to see this stress of banks either having to raise deposit rates for savings and checking accounts, and that'll eat into their profitability, or run the risk of losing deposits altogether as depositors, even sticky depositors, get attracted to this much higher yielding instrument, a money market fund. In addition to that, you could lock in for the next 10 years right now if you wanted to, an essentially risk-free rate of return just buying a 10-year treasury and earn about 4.5%. So for low risk investments, the yields are high, which is awesome for savers. That's really good for savers. But this is hugely problematic for banks, particularly regional banks. And so the pain that we saw back in March, it is not gone. There's, obviously federal programs to help them shore up their balance sheets. Those are set to expire here in several months, but we'll see. Maybe they'll have to continue with some of those lending facilities. But this in general is just not good for banks. And so the benefit, good job savers, high level of yield. Bad side, sorry, banks. But I hope you all enjoyed today's market volatility and yesterday's very hawkish statement by Jerome Powell, as well as the other members of the committee.